Okay, what we're going to talk about in this module is basic life policies. There are a number of different types of life policies out there. Generally, they break down in between two different ones, which is your term or your permanent. And within permanent, they are broken down between whole life and universal life. And of course, universal life is broken down between regular universal life and a indexed universal life and a variable universal life. We'll talk about term first of all. Term is primarily to cover a specific period of time. That time could be you want to have that extra coverage during the time that you have a mortgage. You want to have that extra time covered while you're younger and have kids and larger a need for it because of the bills and what you're going to be putting together, and you may need less when you get older. So it's designed to cover a specific period of time. Since it is designed to cover a specific period of time, it is usually less expensive. Now we're not going to talk about what it takes to qualify for any of these. This is just about the different types of insurance. So that's called term. Within that, there are a number of different things that you can add to it that are usually called riders or options, and there's many of those, but term is one particular type. Within the permanent insurance, this is set up so that from the day that you start paying, it should cover all the way out until you die. In most cases, if it's set up correctly, that premium will never change. Generally, the whole life and the universal have many things that are the same. There are some differences. Universal's newer and in many cases has a wider range of bells and whistles and riders and so forth. Again, we're not going to go into the in-depth stuff. For a permanent type of insurance, basically what it does is it allows you again to have that coverage long term. Now, with a term product, the cost of the insurance generally goes up each year if it's an annual term, annual renewable, because based on your age, the mortality tables will change the probability of you dying, and the older you get, the higher the probability, and hence the fact that it gets more expensive. So when you have a term product that's 15, 20, 30 years, it may be more expensive than if you bought a one-year term at that age. However, it's going to be cheaper than allowing it to go up each year because it's averaging out that risk. All right? Within a permanent product, you have basically a term product that takes care of the cost of that death. So it may be, let's say that with the permanent insurance, the cost of that insurance might be $40, just for example. Out of that 40, initially only 5 may actually be what goes to paying for the cost of the insurance. The rest of it goes into what's called a CVA or cash value account, kind of like a savings account. And what that does is it builds with interest. So each year, the cost of insurance gets a little bit more expensive. So while it was $5 the first year, the next year it may be 6, then 7, then 8, then 9, and it probably isn't an even number progression, but just to give you an example. But at any rate, at one point or another, you're going to reach the time where the amount that's going in, that $40, is not enough to cover the cost of the insurance. That's where the CVA comes in, and how it can be the same amount all the way out no matter how long you live, because the cash value at that point, it starts pulling the difference. So if you get to $41, $50, whatever, then it pulls $1 or the $10 over from the cash value side to add to the $40 you're sending in to pay for the cost of the insurance. If it's been set up correctly, the amount at that point has reached the amount with the interest that it's generating, where no matter how much you have to pull out as it goes up each year, it is still building faster than what you built, what you're pulling out to pay for the insurance, so that you still have that money available to cover, and that way your premium never goes up. Now, it can be set up for a minimum like that to just cover the insurance, but what's nice is it can also be overfunded. And by that, the payment initially, as we said, was $40, but we might set it up to be $60. Every little bit over that initial amount going into the cash value account simply starts building faster, because now you're getting more interest on top of more interest. The reason we would do that is to set up a fund that your children could pull from to help pay for college. It could be to help fund your retirement. It could be to pay down your house early. So there's a number of different reasons why you would want to overfund the account. But that's what you can do with the CVA or cash value side. So I know I threw out a lot there, but just to kind of recap, we have term insurance, set period of time, 1 year, 5 years, 10 years, 30 years, 40 years, whatever the case may be, has a set payment. At the end of the time, it's done. Now, that can also be converted, but it's for a set period of time the way it's currently written. Then you have permanent insurance, which is made up of whole life and universal life, with universal life being made up of universal life itself, an indexed universal life, and a variable universal life. And those are just simply how that cash accumulates its value. And that is a permanent insurance and is designed to stay in place for the length of that person's life.